Hello, my name is Stephen Bates, CEO of QLab Invest. 18 years ago, I left my academic post in physics research and started work as a trader at Merrill Lynch. By most accounts, I was supposedly smart. I had a PhD, I knew how to price derivatives, and I was making money for the bank. My personal savings were also growing, so I decided to invest in the stock market. At the time, towards the end of the 90s, US equities were doing well, and technology stocks in particular were growing the fastest. In fact, all our equity analysts rated them a strong buy with high return targets. So I bought. What made me buy? Was it my highly disciplined analytical side that had served me so well as an academic? No, it wasn't. Actually, it was my gut feeling, driven by greed and overconfidence, two classic psychological biases. At first, the equities made money, and I felt good. Then at the end of 2000, prices started to decline. I held on, I was still in profit. The prices fell further, and I was looking at a small paper loss. I still held on, as I couldn't face selling at a loss. This is the endowment bias at work, which made me believe the true value was higher than it really was. I also had anchored my return expectations on what the analysts had said, another psychological trap. I couldn't accept that they or I might be wrong. Then when I was sitting on a paper loss of about 30%, I panicked and sold everything. Markets went down for another year, so at least I had not lost more. However, when the recovery did start, I did not reinvest. My loss aversion was too high, and so I missed much of the recovery, and I felt regret. It was emotional, and I also no longer felt very smart. The story I've just told you is true, but it is not unique. We all suffer these psychological or behavioral biases that cause us to react on our gut feelings, which are often not rational. In this first video of a short series, I will look into these biases more closely and the effect they have on our investment behavior and on financial markets. Given most people would like their wealth to grow, at least at the rate of inflation, they need to invest. However, investing is not risk-free, and this can be a source of great worry. If I've learned one thing with investing, it is that where money is concerned, emotions are not far behind. Whilst we cannot easily change our emotions, my goal is to remove the worry from investing and give people the peace of mind to invest appropriately and also stay invested through the market cycles. Psychology plays a stronger role than we may think in how we behave when investing. So let us now look at the source of the problem. The human brain is an amazing organ which has evolved over countless generations, doing a great job of keeping us alive. However, today's financial world is very different to the natural world, and our brains are not well adapted to financial survival. The brain's intuitive mechanisms lead to biases and emotions which can adversely affect our decision-making. The brain's instinctive greed and fear responses give rise to noticeable dynamics in the markets, which manifest themselves as momentum, cycles, bubbles, and crashes. These movements are a direct result of countless individuals, private and professional, people like you and me, taking decisions to buy and sell various assets. Despite many people thinking they are acting rationally and following disciplined investment processes, research has shown they are often not even aware of the very biases affecting their decision-making. What else does science tell us about these phenomena? Well, it turns out that markets do not follow a random walk process, but are driven by cause and effect, or in other words, one thing leading to another. The result is that markets exhibit periods of relative calm or equilibrium, punctuated by periods of higher activity or quicker movements. However, just as earthquakes exhibit the same characteristics, it does not mean that movements are highly predictable in advance, but there are persistent properties that can be exploited. For example, just as with earthquakes, if there is a shock in the market and risk increases, then the risk in subsequent days and weeks tends to stay high, the so-called autocorrelation of risk. This is due to investor after investor reacting in a similar way to news or market movements. The high risk is persistent for a while and then gradually reduces back to more normal levels. Also, if markets are moving relatively smoothly in one direction, up or down, then it is likely this continues, at least for a short period, and this is the momentum effect. This is again due to investor after investor following the same idea or trend, a classic herding instinct. With uptrends, just as with a herd of cows leisurely leaving a field for milking, they do not all go through the gate at once, and these kinds of trends can last for long periods of time. However, if the trend is down, investors usually do get out a little quicker, and movements to the downside occur more quickly. The worst happens when panic sets in, and the result is a market crash. The science of statistics allows us to study these patterns of changing risk, steady trends and crashes, and it turns out that over short time periods, risk level and direction of steady trend can be predicted to a certain extent, and thus be used in a disciplined investment process. Crashes are often unexpected, and so a robust and independent risk management process is always required. The key, though, is not to fall foul of the same psychological traps as everyone else, and so when I say a disciplined process, the discipline must be guaranteed. This kind of investing is called systematic investing, and in the next video I will show you how that works in practice. For now, I hope you have realized, just as I did, that sometimes we are our own worst enemies when it comes to investing. Whilst we can never take the emotion out of investing, we can remove a lot of the worry. I hope you'll join me in the second video where I explain how to do this.